been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
On a mission to help people discover, protect, and share true financial independence, we are GenWealth Financial Advisors, and this is the Get Ready for the Future show. Welcome in. For the next 30 minutes, we're going to be answering your questions about money, about investments, about retirement, and all centered around the goal of true financial independence. My name is Scott Inman. GenWealth co-founder John Shrewsbury here with me, and as we get ready to dive into these questions, before we do, we don't want to miss the opportunity to say Happy Memorial Day weekend. It is the official kickoff of summer, and that's what it's known for. One of the reasons it is known around the country for. But obviously, and I said to you a minute ago, John, before we went on the air, if I don't make a point to speak about the true meaning of Memorial Day, it'll get lost on me. And I think it gets lost on lots of Americans, but it is a moment in time to reflect and really just say thanks to all of those service members over the course of the last century plus that have given their life, made the ultimate sacrifice to make this nation what it is, to keep it free, to protect it. And I also want to say thanks to the families who have lost loved ones as well, because we know that you obviously have a piece of your life that is missing in giving that ultimate sacrifice. And I think, it always brings it back to me, John, for Memorial Day, in light of that and what we do, the opportunity to even dream about financial independence only exists because of those service members.
I was just about to say, if you are trying to discover financial independence, you can do that because of those service members. Yep. If you were any way involved in any pursuit, any worthwhile pursuit in America, you owe it back to those people who have died for our freedom. Mm-hmm. Yeah, and it's one of those things that, as you say, if we're not cognizant of that, we don't keep bringing it up, then it's just another day. It's a holiday. It's a day off and all of that. It has nothing to do with barbecues and the lake and all of that type of thing. It has to do with the sacrifice that's been made for us who are fortunate enough to live the American dream.
And it always brings me back to that the United States is, with all its flaws, still the greatest human experiment in history, right?
It is
best thing going.
It's an interesting ride.
Yes.
Especially these days.
Yes, absolutely. But obviously it brings lots of good questions to the Get Ready for the Future show. That's with everything going on. So let's dive in. We'll start with Amy from Little Rock. I'm 62 and just got laid off. I'm eligible for Social Security, but have about $520,000 in a 401k. Should I go ahead and start my benefits or hold off a few years and draw from my savings instead? Amy, a great question and a big decision point for you. You're out of a job and eligible for Social Security, but is claiming now the best move? So let's walk through the decision points. And I think the first and foremost, you have to think about, John, is are you planning to go back to work? Because her mentality here, just based on the question, is, well, I lost my job, and now what do I do?
Yeah, my best advice to Amy is pump the brakes just a minute. First of all, the decision by your boss to let you go, to lay you off, should not necessarily prompt a decision on your part to retire. Now, I get the proximity and all of that type of thing, but you got to be in control of your life, not allowing a corporate decision to be in control of your life. And so I think there's a lot of assessment that has to be done, and that's why I say pump the brakes. And Scott, that assessment begins with, am I ready to retire financially, mentally, physically? All of those things come into play.
Yeah, and we don't know how much she was thinking about it walking in, but obviously it was not on her timing. And that's the point we're trying to make here. You want to be able to control your own financial independence and not just try to make do with what you have because of the bad timing of a job loss. So to John's point, are you going to go back to work? And if so, what are you going to do about that? And in the meantime, while you are without income, and clearly you're focused on that because you're trying to determine how to start that income stream back up, certainly you want to look at filing unemployment while you decide what your future is. But I think the key point here is to take a moment to assess where you are. And John, you alluded to that. It isn't an all or nothing thing in terms of I'm going to just have to get by without any employment income. But it may not be the other side of that either, is you may not have to go back to work full time.
Yeah, Scott, I think a hasty decision here can be just fraught with danger because once you make a decision about Social Security, it is hard to unring that bell, especially after a year. If you go a couple of years and then you go, I shouldn't have done that, you're locked in. Yep. If you go over a year, you're locked in on your Social Security. You do have a redo that you can stop within 12 months, but you can not go back and do anything other than in that 12-month period of time. So, and I would say if you're not ready, you're just not ready. And then you've got to think about, okay, then what does that mean? Am I going to look for another job? If so, can I get a job that's comparable to what I was being paid? Or do I need to think about, okay, can I work part-time? Can I cut back on some expenses? Can I tap into some of the resources that I have? But I think the central question is, have you reached financial independence? And if you have, then okay. If you haven't, then let's evaluate how much further you've got to go in order to get there, because the key is to be able to be financially independent. What does financial independence mean? We throw that term around all the time on this show and throughout the hallways of GenWealth. But here's what financial independence really means. It means you control your life decisions. Money does not. And that's the clearest way that I can put this. And so if you have accumulated enough money to make that a reality, then this is a pretty easy question. If not, then working with a financial advisor to get there over the next few years is certainly something that you can do. And I'll say, Scott, from my perspective, at 64, 62 is young. You got plenty of time, you know. So it's one of those things that I don't know that you need to necessarily react to what the boss has done. You have to take stock of what you have done. And if you're ready or you're close, then that may be a different conversation than if you're not.
And another key reason you need to know this answer, Amy, is if you think you're going to be done and you make the decision to start claiming Social Security at 62 and then realize it's not going to work out and go back to work before your full retirement age, you may have a problem there, because there are limits on how much earned income you can have if you have received Social Security prior to your full retirement age. And those limits are pretty strict. It could be around I think it's around $23,000 for 2025. So if you make more than that in a single year and you are receiving your Social Security benefit, then they will actually, they don't call it a penalty, but they will withhold $1. I get this backwards. It's $2 for every $2 that you earn.
If you're over the limit and you go $2 over the limit, they take $1 away in Social Security.
Yeah, so that can be a big pull against that Social Security benefit. So you want to make sure to make that plan first, and then know if you're on track where your financial independence lies, whether it's now, whether it's at 65, whether it's at 67, and then you can begin to know whether you need to layer in Social Security. And the equation here is pretty basic, John.
Yeah, it is. And I think that if you're trying to evaluate this on your own, this is a real simple equation. Is I greater than E? I is income, E is expenses. Most people, and I find this just shocking, most people have no idea what their expenses are. They don't know how much money they need to have every month for them to be okay, for them to pay their basic living expenses. They kind of commingle, if you will, basic living expenses and discretionary spending. But I think when you get to retirement, you need to have a very clear understanding of what is a required expense and what is a desired expense. It's okay to have both of them. There's not any, negativity on either category, but you got to know your numbers. And so what I would say to Amy is sit down and let's take stock. Work with a financial advisor to help you sort through all of that and decide whether something is actually a need or a want in terms of what your expenses are. And then you evaluate your income sources. Social Security is clearly an income source. Amy talked about the fact that she's got $520,000 in a 401k plan. That could potentially be an income source to you. So you've got to go through this evaluation process, and an advisor can help you think through that in addition to all of the other areas of retirement. There's a psychological factor here as well, because what are you going to do with your life at 62 if you stop working? That's not necessarily a bad thing, but you've got to have a plan. The whole key is to get that plan on paper on purpose.
And Amy, I think your question brings into light the situation of many others. We know that we're working with several people right now who are federal workers wrestling with the buyout option. Maybe not a layoff situation. It may be somewhat voluntary, but they're trying to work through that with everything that's going on with DOGE. They're faced with this very decision. So I want to reach out to anyone listening or watching the program that if you're kind of wrestling with, do I have enough to go ahead and step off into retirement and take a buyout package and no longer work, even though it was not really in my initial plan? Making a plan for true financial independence is never more important than right now for you, and you can walk through the GenWealth Ready to Retire process to find out those answers. Do that by calling us toll-free, 866-653-PLAN. That's 866-653-7526, or email us. Send it to show@getreadyforthefuture.com. And a reminder to subscribe to our YouTube channel for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. Just go on YouTube and search for GenWealth Financial Advisors.
Can I say something about YouTube? I'm just amazed. I was sitting there, I was consuming some things on YouTube the other day, and I'm like, you know, I spent all this time in school, and I could have just been sitting at home in my jammies and watching this if this had been around when I was a kid. You know, I could have just graduated with honors or something. I don't know. It just was, it's amazing the time that we live in. Wow. And that gives us the opportunity to push this whole thing of financial independence and helping people to be educated about their money. Because if you're not, then you make decisions like Amy was asking about that are out of knee-jerk or out of instinctive reactions as opposed to an educated position.
Yeah, and we're trying to sift through all of that noise that is on YouTube and everywhere else.
Oh, yes,
right?
Absolutely.
Because you can
tons of it out there.
You can go down the rabbit hole for sure. Next up on the program, it's Charlie via text. We have a mix of accounts, $850,000 in traditional IRAs and about $320,000 in a Roth IRA. We're both 66 and about to retire. What's the smartest order to draw from these accounts to keep our taxes low? Well, you've got tax-deferred and tax-free buckets. That's great walking into retirement. Which one do you tap for first? Order matters more than you might think, and really it probably is going to end up being a blend, right? First of all, congratulations on having $320,000 saved in a Roth. That opens up lots of options and flexibility for you in terms of a withdrawal strategy in retirement. Don't really see those kinds of Roth numbers very often, because what happens is your income, if it goes up past a certain point during your pre-retirement years, it makes you ineligible to contribute to a Roth IRA. So a lot of higher earners later in life have to stop contributing to a Roth IRA. So it does put some caps kind of naturally on how much money we see in Roth. But the first thing, John, here is to determine what kind of income you'll need to live on. What is the total income need?
Yeah, the total income need is the jumping off point, and that's kind of what we were stressing to Amy in the previous question. You got to know your numbers, got to understand what that looks like. Now, there's a lot of different ways that you could approach this. One of the things that you may want to consider is blending in the traditional IRA money, 401k money, whatever the case may be, the pre-tax money in with some Roth money to lower your overall taxable income. Here is a phenomenon that happens sometimes, and you know, for the longest time early in my career, we were taught you want to just defer. Well, here's what has happened. We've had a long-term bull market. Despite, you know, the volatility that we've had recently, the stock market has been on a tremendous run throughout most of my career. And so when you look at that, the effect of that has grown this big bubble of money that has not been taxed.
Yep.
And if you're in an individual situation where you've got money in pre-tax dollars and you continue to push the money, the withdrawal of that money down the road a ways, then you can create this big tax bubble that you have to deal with, because at 70 something, you're going to hit RMD age. And I say 70 something because it's a floating number. The oldest is age 75, but you're going to hit that number at some point in time, and then you're going to be forced to withdraw massive amounts of money out of your IRA accounts, and that's going to throw you into a lot higher tax bracket.
Yeah, not to mention the transfer of wealth to the next generation, and the laws have changed around that over the last 5 years. So if you inherit an IRA, you've got to take it out in 10 years. So there is a big tax bomb coming in those traditional IRAs or pre-tax 401ks. So it does make, to John's point, it does make sense to blend this at the very least. I don't think you want to live on exclusively Roth dollars until those are depleted and then switch to the traditional IRA. So when we talk about your total income, figuring out your total income, including Social Security, because at 66, you're going to be layering in some Social Security here. It is not fully taxable at the federal level, but up to 85% of the benefit is, and more than likely, most retirees are going to hit that 85% clip. It's not taxed at all on the state level in Arkansas, so depending on what state you live in, that would matter. And then figuring out what you want to live on will help us determine what your federal tax bracket will be, roughly, in those early years of retirement. Of course, that could change as well, which also lends us to the belief that you need to start pulling it out of the traditional tax-deferred accounts, at least partially, because more than likely those tax brackets are going to go up rather than down. So I think that's a big first step for everyone who's thinking about how to blend those sources of income, John, is to figure out where you're going to land on a tax bracket, and then if you can use the Roth dollars to offset or to keep you in a lower tax bracket, that'd be probably a great way to be minimizing taxes
while you're meeting your overall income need.
Yes.
In that calculation. Now let's nerd out here for just a second. If early on in retirement you could limit your taxation as much as possible, what that could potentially allow you to do, especially if you've got some money sitting on the sideline and you want to do this, you could look at doing some pretty significant Roth conversions. Now, you would be using Roth money to create that tax-free income, so your overall tax bracket is down, and so you're converting dollars at a low tax bracket out of the traditional IRA account, and you have to kind of, because you are chasing dollars to some degree there because you're consuming Roth dollars, so you have to convert maybe 2 for 1 or something like that to really get ahead of the game. But at the very least, you're getting a lot of that pre-tax money taken care of as far as the taxes are concerned in a much lower tax bracket than maybe it would be otherwise.
Yeah, and I think that that brings to mind too another way that you can do that without having to raid the Roth is if you can build up a pretty big pile of cash in that first year of retirement, right? If you can live on after-tax cash and then convert the Roth, because that cash is not going to be taxable, so that can help out too. So looking at Roth conversions can help, but I do think keeping a significant amount in your Roth IRA and not raiding it in the early years, as we've talked about for the reasons we've already discussed. But another reason is you never know when you're going to need a little bit more or even want a little bit more. If you want to buy a new car or go on a once-in-a-lifetime trip and it doesn't fit into your overall monthly income plan, that Roth can be tapped at any time, John, for an extra or lump sum purchase.
And here's the pitfalls of taking that money, especially if you're over age 65. You can really rack your Medicare premiums up by making a major purchase. Because if you go over the IRMA threshold, as it's called, then you're going to be in a situation where you're going to be paying higher Medicare Part B and Part D premiums. So you have to be careful about that. That does not apply to Roth money. So Roth money doesn't raise your AGI, your adjusted gross income. Roth money is tax-free, so it doesn't count. So if you had to make a $50,000 purchase to buy a new car or to go on a trip or whatever the case may be, that $50,000 flies under the radar as far as the IRS is concerned. The complexity of all of this is why you need to work with an advisor, because they can help you walk through this very carefully and understand all of the angles on this. Scott, I just had a client contact me the other day who said, I want to do some Roth conversions, and he had a number in mind. Well, his number really needed to be somewhat less, about $30,000 less than that, because of the IRMA issue.
Charlie, your question is the question of the week. We'd love to send you a free Get Ready for the Future Show tumbler. All you have to do is email us and claim it. Send it to show@getreadyforthefuture.com. Our next question is from Jeremy. He sent in an email and says, we live in a 4-bedroom home that's worth about $390,000, but we're thinking about downsizing to something under $250,000. With interest rates up, is this still a good move? And how do we know we'll actually save money doing it? Less space, more freedom, maybe, but downsizing sounds simple until you crunch the real numbers and consider the lifestyle impact to determine if it's right for you. And the interest rate question is a very substantial one, because if you are leaving a mortgage that has a very favorable rate, most people that have locked it in for any length of time are looking at 3s, 4s, and now you're having to buy something with a new mortgage at 7%, 8%, that is obviously going to be a trade-off where you're downsizing and you may not actually lower your mortgage payment. But John, the first question here for him is, what kind of equity does he have?
Yeah, is the home debt-free? If the home is debt-free, then the interest rate issue is moot. If the home is debt-free and you've got a $400,000 home, roughly, from what I understand from the question, and you're going to go buy something with $250,000, you're going to put some money in your pocket, about $150,000 in your pocket. Maybe not quite that much with closing costs and all of that, but you're going to put a substantial amount of money in your pocket, and that could be a really good thing. But if you have a mortgage and you have to pay off that mortgage at 2 or 3 or whatever percent rate, then there is some sticker shock when you go in and go, okay, 7 or 8. Although I want people to really understand this about the mortgage environment right now. The mortgage environment isn't abnormally high. The mortgage environment was abnormally low a few years ago. And we got a real bad case of recency bias on some of this, because, interest rates have normally been in the 7 to 8 range for houses. If you go back 30, 40, 50 years and look at all of that history, the average rate on a mortgage is substantially higher than the 2 or 3% rate that we really got used to.
Yeah, and the takeaway there is really we shouldn't look for them to come down much anytime soon. So waiting on interest rates to go down, if you're wanting to make this downsizing move, Jeremy's probably not going to be the right strategy. But, John mentioned being debt-free. If you even have a substantial amount of equity, if you had even $250,000 in equity to buy the $250,000 home, you're in great shape. So figuring out that mortgage payment at the new house, if there is going to be one, is the first piece to that. But it's not the only cost saving that you might actually incur there. Things to think about there. Your maintenance costs are probably going to be lower on a smaller house. I mean, even something as simple as how often you have to replace light bulbs, if you really want to nerd out right here, right? Yeah. I mean, just replacing light bulbs, electricity bills, utility bills are going to be lower. The other offset to that, though, that I would consider if you really want to crunch the numbers here is where are you going to move to, right?
Yeah.
He doesn't say, are we going across the street? Are we leaving the city? Are we leaving the state? Because cost of living around where you're going to live in the new home is going to be a big deal, too.
It is. And let me just kind of share a quick personal story. I built a house about, that was in 2014. So it was about 11 years ago. We built a pretty good sized house. Now that we are empty nesters, I'm kind of like, well, we live in about half this house. Yeah. And it sure is costly to keep it up. And the electricity bill is high and the yard maintenance bill is high. I have terrible allergies. And so I can't go out and mow the yard. So I have to have somebody come mow the yard. All of those things come into play here. If you take a look at, is there going to be any real savings? Then you can maybe make a case because we put a lot of money into the home when we bought it. And so there is that factor there. But to Scott's point, trying to find something that you really like is a problem. Now, I like being on the water. I live on a lake, and there's not that many lakes in Saline County where I'm at. And so it is, problematical to find that house that you're looking for. And if you do find a house that you're looking for that is just the right spot, is it the house in particular that you're looking for? A lot of houses were built 20 years ago. And so, when you go in and look at that, are you going to have to go spend money to upgrade stuff and all of that? You're not going to walk into a brand new house somewhere and find that delta that you're looking for in terms of finances in a real productive way if you are really particular about the house that you're actually moving to.
Now, Jeremy's talking mainly about the cost savings move of relocating, but that is a major consideration for a lot of people when they retire, is relocating maybe to another state. Lots of considerations. Working with a financial advisor there. One we didn't even mention was the health care. How close are you? What's your proximity to hospitals and doctors? And of course, finding new ones if you go very far from where you currently live. So a financial advisor can help you walk through that, not just the dollars about it, the savings part of it, but also the other considerations as you begin to live your life in retirement much differently than you did in your work life. Great question, though, Jeremy. Thanks for it. We finish up today with Anthony from Maumelle. We're both in our late 50s and don't have long-term care insurance. We've got about $2 million saved and are in decent health. Is it too late to get a policy that makes sense, or are we better off self-insuring? Late 50s is not too late. First of all, it's the elephant in the room. Long-term care, if you're approaching 60, is it too late to protect yourself? No. 55 to 60 is kind of the great sweet spot to look at insurance policies, primarily because if you think about it, if you do it much earlier than 55, then you're going to be paying the premiums, statistically speaking, for a longer period of time before you actually would need the coverage potentially. And if you wait much later than age 60, the premiums are going to start to look pretty cost ineffective. So I think this is the sweet spot. So Anthony, the first part of your question is pretty easy. It's not too late to get a policy. Now, the first piece, though, is determining if you need one. And so what type and what kind of coverage if you do. So there's a process we would want to walk through here in determining your income plan first. So with $2 million in savings, John, they're off to a great start to be able to have the retirement they want. And it may not require all of their assets to give them their retirement dream. And that may allow you to peel off a little bit to put into what we would call a long-term care bucket.
Yeah, the long-term care bucket can be self-funded. There's no doubt about it, but you've got to have a real clear understanding of how that works. If you have all or mostly qualified money, then you've got to look at it on an after-tax basis, because you're going to have to pull that money out of an IRA account, pay the taxes on it, and then pay the long-term care expense. And you can very easily calculate if there is a defined benefit to a long-term care policy, let's say of $500,000. If you've got an extra $500,000 in your overall plan, then you might get there, but you might need a little bit more to pay the taxes on that $500,000. But Scott, I think you also have to ask yourself, what is it that you're trying to protect? With $2 million, you probably will be just fine paying out on long-term care. But if you're trying to protect your own assets to pass to the next generation, that could be where long-term care can come into play. Just think about it as a substitute for self-pay. Long-term care actually pays those expenses with what I would call discounted dollars. So think of it this way. If you have a $1,000 bill that you have to pay for long-term care, and you take that out of your retirement account, then you're going to have to probably, let's just say, take $1,300 out of your retirement account to pay that $1,000 bill. Conversely, if you have a long-term care policy, and let's say that you're paying a few $100s a month for that policy, then that $1,000 bill gets paid for by that long-term care policy that you have incrementally paid on over the years, and it doesn't cost that same amount of money. You're paying for it with a discounted dollar. And so that's the magic, if you will, or the math of a long-term care policy and how it might protect that asset so you're not spending down that asset that you'd like to go to your spouse or to the next generation.
And the other way this could work very well too, John, is we talked about having a long-term care bucket if you don't need all of your assets to support your lifestyle in retirement, but you could also use a little piece of that bucket to pay the premium on the long-term care policy. So in other words, raise your monthly income that you're planning to live on so that you can pay a policy for you and or your spouse. So then it becomes a little bit of a discussion of, well, what type of policy should you look at? You know, there's a real challenge with the traditional long-term care policies that are out there. Number one, it is a use it or lose it situation. In other words, you could pay the premiums from the time you're in your late 50s all the way till your late 70s, and then you could die suddenly or quickly and not really get any advantage out of that policy. So you paid those premiums and they went with the wind and didn't come back to you in any way. The other piece to that is the premium's not likely going to be level. Since it's kind of tied to a health insurance chassis, you're going to be seeing premium increases over those 20 years that you're going to be paying, statistically speaking, before you need care. And that could make the policy very unaffordable right at the time you need it. Now, maybe not in Anthony's case with the kind of assets that he has, but John, we've seen that happen with clients who are a little bit more constrained with their monthly income, that the rates go or the premium goes up so high they can't afford it anymore.
Yeah, and Scott, another real problem with long-term care and what goes on up here when people are thinking about it, when you're not in need of long-term care, then you're 10 feet tall and bulletproof. That's not ever going to happen to me. I don't need to worry about that. I'm never going to go to a nursing home. I'll die first. Or, there's all kinds of things we tell ourselves. But then when you need it, it's too late. You can't get the coverage. It's just like you can't go get car insurance to cover the accident you had last week. It doesn't work that way. And so the prudent thing to do is to carefully evaluate what your need is. Scott, I believe that there is a threshold of wealth that you can attain that you don't need long-term care coverage. I have several clients that are in that situation. I believe there's also a situation where you don't have enough assets to protect and you're likely going to need some type of assistance. And so that is not going to be a long-term care case because you simply can't afford the premiums. But there is a middle part of the spectrum of society of a lot of people that do need to insure against a long-term care event. And a traditional long-term care policy can go up in premiums, as Scott has accurately mentioned. You want to have something that you can control the cost and that you know that you've got a source to continue to pay that cost until you need the coverage.
And that option could look like a life insurance policy with a long-term care rider on it. So this is not going to be use it or lose it. There's a pool of money that will either go to your heir if you die suddenly, or it will go to you to provide yourself care if you need long-term care. Those premiums typically remain level. They might start off a little bit higher than the traditional long-term care policy because, look, you're covering two ways that you're going to get paid. Somebody is going to get paid out of that policy, but it does remain level throughout the rest of your life, and that has turned out to be a pretty good option for people looking for long-term care coverage. You heard the bell there in the background, so it's time for our final thoughts, John.
Scott, we've been through a lot of complex questions today. Retirement is complex. Life is complex. Being financially independent sounds simple, but it's complex. And I think that the job of a financial advisor is to take the complexity that we've been through on the show and in the summary of the show that we've got here in front of us, take that complexity in your financial life and boil it down to very simple concepts that we can all grasp. That's really how a financial advisor helps you to discover, protect, and share true financial independence. Financial independence is within your reach, but you probably can't get there on your own. Now, some people can, but a lot of people need the guidance, the help, the assistance, and really the work of a financial advisor is right in that realm. And I would recommend to anyone listening to this show that feels like there's a lot of information here, get into a relationship with a financial advisor so they can take the complex and reduce it down to a simple concept that you can make a decision on.
Yeah, if you're in your late 50s like Anthony, if you're 62 like Amy, and you're really starting to try to piece this retirement puzzle together, it is time to get a written plan on paper, on purpose, through the GenWealth Ready to Retire process. To get started on yours, you can call us toll-free, 866-653-PLAN. That's 866-653-7526. 866-653-7526, or email us. Send it to show@getreadyforthefuture.com to get started on the GenWealth Ready to Retire process. That's all the time we have for this week's Get Ready for the Future show. Thanks for being with us. I hope everyone has a great Memorial Day weekend. We'll talk to you again next week. And if you have a question for us, get it in to us. You can text or leave a voicemail to 501-381-5228.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.